Hey everybody, Steve Olson here with the Peak Group. I've got my good buddy here, JT Lindsay with Peak Funding and Momentum Loans. We're going to talk about financing today and some of the intricacies to consider there. I guess first of all, though, JT, Peak Funding, Momentum, what's the difference?
Yeah. So currently right now, what we do is for all of our conventional financing, which is the bulk of the loans that we do, are going to run through Momentum Loans. Construction loans, commercial loans, those type of things, you'll see those run through Peak Funding. As of right now, there may be some changes coming up here shortly, but that's, what you're going to see as of now.
Gotcha. Well, and I think that's really what we're here to talk about today. And for some of you, this might be a little bit of a review, but for others, it's important because recently I did a video about the multi-dimensional ways that we can benefit from investing in real estate. And one of those was leverage. The kind of leverage you use, how much of it you use, definitely impacts things. It impacts the broader market, not just the specific investment that you're into. And so we want to get into a little bit with JT about some of the key differences in conventional financing, what that is, debt service coverage financing, DSCR. Why would we use one over the other? What are the terms looking like as we record this, which is in mid-February of 2025. So people say the term all the time, Fannie loans, Freddie loans. Mm-hmm. That's conventional financing, but what is that more broadly?
Yeah. So I think the easiest way to think about conventional financing is really what they're looking at is you as the borrower, your ability to repay the loan, right? So some of the key factors that they're going to look at is credit scores. They're going to look at your debt to income ratio, right? So your debts versus what your income looks like. They're also going to weigh in pretty heavily your work history, right? Are you W-2'd? Are you self-employed? If you are self-employed, what does that history look like? A big one that people get caught up on is in, self-employed income. Do you have declining income? That can cause a lot of wrenches in what we do. But really the easiest way to explain it is your ability as the borrower to repay the loan. That is what conventional financing really focuses on and looks at.
Okay, so let's say I'm getting a conventional loan to buy a house. Mm-hmm. All they're looking at is everything that you just said, and the house could be $1 bajillion, but if my income and debt to income ratio is enough, that's it.
Yeah. In theory, very easy way to say that. I mean, we do have loan limits if we want to dive into that, but yes, that's exactly what they're looking at. If your ability to repay the loan meets Fannie Freddie guidelines, then you will get the loan.
Okay, so some of the red lights, the non-starters, mm-hmm. I've heard. Number one is if your debt to income ratio, what is it, 50%? Or what is the ratio where they say you're not getting the loan?
Yeah, so on a primary residence, we can typically go up to 50.
Okay.
As long as you have a good credit history, right? You've made payments on time, good credit scores. We'll see a lot with investors that sometimes can go down to 45, sometimes 47%. But what's really interesting about it, a lot of people don't understand is they're looking at more, there's a lot more to the loan file than just maybe, hey, I make a ton of money, so why doesn't this work?
Yeah.
Right? So, for example, I've had investors who have a lot of money in reserves and they're buying an investment property and we can go all the way up to a 50% debt to income ratio.
Because of those cash reserves.
Reserves. Or I may have an investor that, their debt to income ratio is 47%. But, they barely meet the reserve requirement and we can't get an approval, right?
So talk about that. What is a reserve requirement?
So, it is all based on how many investment properties you have. So it goes in tiers. And I should know this off the top of my head, but I don't. But there's different tiers. So once you have 4 or 5 investment properties, then they're going to want 6 months of reserves for those investment properties. If you have 7 or 8 investment properties, then maybe instead of 6 months, now they want 9 months of reserves. So depending on the investment portfolio will determine what reserve requirement is needed.
Okay, so I got to go there then. The source of this cash that I'm going to use to make a down payment, I think is important.
Yeah.
And also what qualifies as reserves.
So money in your bank account, right? So if you have a money market account, any type of liquid account where you can pull money out of, we can use that for reserves. We can also use 401ks as long as the 401k documentation allows you to pull out. Even if there's a penalty, that's still fine.
Yeah. Cash value life insurance?
I don't know if I've ever come across that.
Okay.
If you have the ability to pull that out, as long as that's in the operating documents, typically that's going to be okay. And I'm saying that now, but that's something that I probably want to look into a little bit.
Yeah.
Where it gets a little bit muddy is a lot of people have money in crypto, right? So
Yeah.
crypto gets a little bit hard. I've literally had people tell me that they have cash, and that gets extremely difficult.
Will you take a picture and send it to the underwriter? This is from my mattress.
That gets difficult. Another one where, it can cause some issues is, business owners have money in a business account.
Okay.
Right. And they'll say, hey, well, I have all this money in my business account. Well, if they have, let's say they own it 50-50, well, then we may only be able to use 50% of that reserve. Right.
Yeah.
So there's definitely some intricacies to it, right, that we kind of have to vet. And at the end of the day, what it comes down to is the guidelines, right? Fannie and Freddie set their guidelines, which we have to follow. And, 99% of the time, it's going to clearly stipulate, here's the guidelines, and that's what we follow.
Okay, so I'm on a couple of social media groups for real estate agents. I just like to see kind of what they're thinking about. And there was a meme that somebody posted of one of their friends betrayed them. They're a realtor, and they didn't use their friend to buy a house. And they said, hey, I'm under contract to buy a house. We close on Friday. And the joke is, well, cool, you should celebrate by going to get a new car, right?
Yeah.
The real estate agent is trying to sabotage the transaction because the rumor is you buy a car right before closing and it's going to blow everything up. Is there any truth to that?
There is some truth to that.
Okay.
Yes. We always recommend as mortgage professionals, don't go open any new credit cards. Don't go buy a new car. Don't up any credit lines. Because what will happen is we have your credit set up on a monitoring service. So if your credit is pulled for any reason, then we get notified that, hey, there may be a new line of credit out there.
Yeah. What did you do? Explain yourself.
Yep.
Yeah.
Yep, exactly. And so, if your debt to income ratio is really tight, let's say it's at 49%, and you go buy a new car, then you may no longer qualify for that house. A lot of times, if it does happen, we get some documentation to support what the payment is. And as long as it doesn't hurt any ratios, we're okay. But that is not a fun experience to go through, right? You're ready to close, and all of a sudden we're asking for more documentation at the 11th hour. So definitely avoid it at all costs.
Yeah, those underwriters, they've got a checklist and they're gonna go through it. I was doing actually a refi with you 6-ish months ago, and this was to pull cash out of an investment property. And I have a K1 from some stock I own in an oil pipeline company. I have like $500 into this, and we got to have this K1.
Yeah.
Right? It's like, you want to see my 37-cent dividend? If that's going to make or break the deal, I don't think we should do this deal.
That is a real thing. I mean, those guidelines, we have to follow those, and just, a big reason why is because if we don't meet those guidelines, then us as the mortgage company, we have to buy that loan back, right? And that's just, we'd prefer not.
You don't want to do that.
Yes, we do not want to do that.
Yeah. Okay, so tell me, what is the truth and the myth to, I'm buying a rental property, it's already leased, can those rents offset my debt to income ratio? Can it make me actually look better?
Yes, absolutely. So what we do is we actually when we order the appraisal on the rental property, we order a rent schedule. So the appraisal will go out and kind of determine what the actual rent, what they think rents are. And then that's what we can use towards income on your loan application.
Okay.
Right. One caveat to that is we can only use 75% of whatever the projected rents are.
They're going to offset that for expenses. And
exactly. Maybe lost vacancy, whatever it is. And so, to make it really easy, if it rents for $1,000, then we can use $750 to offset your new mortgage payment. So
gotcha.
It is absolutely something that we can
So if you're buying income property right, your debt to income ratio should be improving with every investment that you add.
Yeah, absolutely. And what's really cool about new construction is, because I get this a lot, right? People that are doing new construction will say, hey, well, it's not rented yet, so can we use it? And yeah, we can. We can use projected rents to help offset that new monthly payment for your mortgage. So
okay. What are some of the no-goes? What's going to kill a conventional loan application?
Oh, so I'll tell you the biggest ones that I experience when you're self-employed. Writing a lot of your income off, right? That is the biggest thing that we run into. So, I'll have people call me and say, well, I make a ton of money. And it's like, okay, great. Send in your tax returns. I'm self-employed. Okay, that's not a problem. We'll look at that. But then when we pull it, when we review the tax returns, most of the income is written off. And, even though they may think they make a lot of money, according to Uncle Sam, you don't make that much money.
Well, you want to look broke on paper so you don't pay Uncle Sam.
Exactly.
But you want to get loans.
Yep.
Yeah.
So there is a fine line of, what to write off and what's not. And really what I tell a lot of our investors and people buying homes, if you are self-employed, send me your taxes before you file them. If you know that you're going to be buying a property, send your taxes to me. We'll review them and say, hey, this is the income that we can pull off your taxes right now. Yeah. And if it's too low, then you can't write as much off, but you may have to not write as much off for 1 year. And then the next year, if you're not going to buy a property, then write as much off as you want.
Okay. So what is the truth and the myth to this whole every investor can only have 10 conventional loans?
Yes. So, I've been talking a lot about those Fannie Freddie guidelines. Fannie Freddie has set a limit at 10 conventional loans under your personal name. So once you reach that 10, you are no longer available to get conventional financing. I've had a lot of people ask, is it 10 doors? Is it 10 property? What is it? So it is 10 loans. So if you have a fourplex, you can have 10 fourplex loans on there.
And then 1 to 4 unit properties are a conventional loan.
Yep, exactly. Yeah. So it's just 10 specific loans. And then, once we reach that 10 loan limit, then we need to look at, alternative financing, whether it's DSCR, commercial, whatever we have access to, and which makes most sense.
Okay, so the advantage of conventional is it's fixed, right? Typically, as long as you're making your payment, nobody is going to bother you.
Yep.
Not like commercial. I'm getting bothered by my lender on a commercial deal right now. I have to pass a covenant check every quarter. They want to make sure the property is performing, but make your payment on conventional, nobody cares.
Yeah. No, I think conventional is one of the best products out there, right? If you qualify for conventional financing, 30-year fixed interest rate. There's no prepayment penalties.
Yeah.
You can refinance anytime you want. As you said, as long as you're making your payment, no one's going to bug you. Whereas commercial, a lot of times there's balloon payments to it. It's only amortized over 25 years and it's a variable rate usually. Right. So after a couple of years, usually it's a 5-year balloon and then it's going to start to be variable. And those loans are really designed to refinance out of within that 5-year period. Right. Whereas
very few keep that loan for 30 years.
Yeah. Whereas conventional at least gives you the option. Right. If you get in, we have a lot of investors, right, that locked in 3% interest rates where there's a good chance they could keep that for the full 30 years, right? If they decide to hold on to it that long. But it just gives you a little bit more control, I think, right? Where you're not going to be held to some adjustable rate that you have to refinance out of on a commercial loan.
Yeah. Well, that's interesting. Somebody I used to work with, a guy named Jason Hartman, he does a lot of podcasts and real estate stuff. He calls it inflation-induced debt destruction. Right. It's a catchy term. I'll give him points for that. But you've got that 30-year fixed rate mortgage parked at whatever it is. If the federal government keeps spending, if things keep inflating, right? For example, my grandpa, rest in peace, he passed away about a year ago. I remember he came back from the Korean War and he won a bunch of money in a poker game in Okinawa.
Okay.
On his way back. And I believe he used some of that money to buy a car and to buy a house in West Los Angeles, where he was from, and just got in the game. And, you lock those mortgage rates, and sometimes they were really high. Sometimes they were comparatively low over the years. And the inflation just blew that debt up for him.
Yeah.
Right. It's a good strategy. So what are we looking at right now? What are you seeing on rates for investment properties? Are they different for fourplexes versus homes?
Yeah.
Are they different for 20% down versus 30% down? Talk about that.
Yeah. Let's start with the first one. So, kind of what we're seeing right now is on an investment property, let's just say single family home in Alabama. We have properties in Alabama right now that our investors can come by. We're probably looking for, let's say we were to pay a point in originate or a point in discount, right, to buy down the interest rate. We're looking at about 7% today. And that's held pretty steady for the last, probably say 3 or 4 months. We've been kind of, a little bit higher some days, a little bit lower some days. I would say over the last maybe couple months, they've, started to trend down a little bit. But, we could always, with a couple points or a point, we could get pretty close to 7, over the last 4 months or so. As of right now, there's really nothing indicating that they're going to come down significantly, right? Rates really a lot of investors ask me this, like, well, what's going to cause rates to come down? And I said, economic growth, right? If the economy is doing well, then there's really not a big reason for rates to come down. If we see the economy start to struggle, right? Jobless claims go up, then we're going to start to see rates come down a little bit. So as of right now, the economy seems to be humming a little bit. And so I think we're going to see rates, stay kind of where they're at for the next little bit, outside of some unforeseen event that causes rates to come down.
Are you comfortable discussing, we talk about the federal funds rate.
Yes.
We also hear about the 10-year Treasury
Mm-hmm.
and how all this goes into a pot.
Yes.
For mortgage rates.
Uh-huh.
Educate the people, because there might be some people around here that don't fully understand that.
I may not be the best to educate, but I'll do my best.
Okay.
Right.
That's all I ask.
So let's start with the first thing. So the Fed funds rate.
Yeah.
Right. Everyone tells me, well, hey, the Fed's going to lower rates, so mortgage rates are going to come down. Well, if anyone's been paying attention to interest rates recently, the Fed's lowered the Fed fund rate, and we saw interest rates only go up. Right?
Yeah. Everyone thought they're going to go down.
That debunks that myth right away. Okay. The 10-year Treasury. A lot of people ask, hey, how do I see where rates are going? Like where they're trending? And that's where I would say that's where you want to watch the 10-year Treasury. Okay. The 10-year Treasury is not going to tell you what interest rates are. It's just going to tell you how they're trending. So if you go pull up the 10-year Treasury over the last 6 months and it's going down, more than likely interest rates are going down. On a day-to-day basis, sometimes you'll see that break a little bit and separate. But overall, if you watch the 10-year Treasury, that's going to give you a really good indication on where rates are trending. Now, what's been really interesting, and this is maybe a little bit more in depth, but there's a spread between where interest rates are and the 10-year Treasury is. So typically, historically, that spread has maybe said, hey, if interest rates are X and the 10-year Treasury is X, that spread has maybe been 150 basis points to 125 basis points. But what we're seeing today is that spread is closer to 270 basis points. Right. And so a lot of people, if you hear people talk about mortgages, you'll hear about, well, tell me about the spread on the 10-year and, interest rates. And that's kind of what they're referring to is the difference between the 10-year and mortgage rates. And that spread is really high traditionally, right? We've typically seen that quite a bit lower. And so we're hoping, to see that spread compress a little bit and interest rates come down, even if maybe the actual Treasury, 10-year Treasury doesn't dip. If that compresses between the interest rate and the 10-year Treasury, you could see rates come down a little bit. So.
Right. So that's more of a symptom of uncertainty, of kind of looking forward, of you don't want to be the lender that issues a mortgage at 6 when all of a sudden rates go up to 7.5 and you're stuck. So because they're worried, that spread is really wide.
A lot of volatility causes that big spread.
Yeah.
Right? Once things come back to some type of normalcy and people are comfortable, that's when we're going to see that compress.
Yeah.
Exactly what you said.
Could make the argument that Trump's here now, so things won't be normal.
Yeah. It hasn't been so far.
It's been fun.
It has been.
I mean, if you value entertainment.
Yeah. I don't mind Doge and what's going on there. I think that's been fairly entertaining. So
I read this morning that they have been taking federal employee records and literally hiding them in a mine shaft. Did you hear this?
Yeah, I read all about it. That's kind of crazy.
After we're done here, I know what I'm doing. I got to read about that.
I don't even want to try to understand that, to be honest, but it is pretty crazy what's going on.
Well, I'm going to add something to that, but I'm going to ask you a question that I didn't warn you about that's going to put you a little bit on the spot.
All right.
I'm going to add to it to buy time for you to think.
Okay.
I want to hear about what the weirdest reason is you've ever had to deny a loan.
Okay.
I know you've got something, but really building off of what JT was saying, we talk about the 10-year Treasury. These investors that are going to fund mortgages, life insurance companies and big institutions and everything, the 10-year Treasury is the competition to mortgages. If somebody wants to loan money for 5 to 10 year period, the 10-year Treasury is what they're looking at going, okay, we can do this, which is at this percentage, or we can do mortgages. And the mortgages are going to have that spread. And like we talked about, they're feeling like I got to have more than I normally would to do mortgages as opposed to the 10-year. So we're going to have to watch that through the rest of 2025. I mean, it seems like, the 10-year loosely follows the rate cuts, but it hasn't lately. We just got to see if, above all, there's some compression in the relationship between the 10-year and the mortgage rate. So that was my thoughts on it. But the weirdest reason you've ever had to decline a file.
Oh man, the weirdest reason. That's a great question. I've just been kind of thinking through it as you said that. And this maybe not be as much weird as it just was alarming and kind of a big deal. So we were doing a loan, and this person was trying to occupy it as their primary residence, and they were a nurse, and they were on the cusp of qualifying, and their debt to income ratio was really high, good credit scores, different things, but we were getting near that 50% and
iffy, yeah.
And nurses are really difficult to qualify because they have shift hours, and their hours are kind of crazy, and so income was really funky, and we were doing the best that we can with what, we were given. And I'm very transparent with my borrowers, right? If there's an issue, I say, hey, here's the issue and here's what we're kind of up against, right? We don't take fraud lightly, right? I mean, mortgage fraud is a very serious thing. And, obviously we would never condone that. And
it's a great way to go to jail.
Yeah, absolutely. Yeah. And so, I was working with this borrower, and, I said, hey, your income's really tight. Our debt to income ratio is I think we were right at like 50.6, right? And technically we were getting an approval at that time. And when we ordered what's called a verification of employment, where they send back their hours and their overtime and all this stuff, it came back a little bit less than it was the 2 weeks previous that we ordered it. So that caused the debt to income ratio to go above 50 to 51, and he no longer qualified. So I explained to him the situation, and it was a scenario where it's like, okay, well, I'm doing a lot more overtime, so on my next pay period, it should be good, and then we should be able to count that and get the income up.
I think I know where this is going.
And so I said, okay, let's do that. I said, we may need to get a letter from your employer just to verify that this isn't abnormal. You're not just working a little bit more to try and qualify type of thing. And he said, okay, that's fine. So it came time to get these letters. We needed to get the letter from the employer. And they send we get the letter from the employer, looks great. We order the verification of an employment, and that looked good. But when we sent in the letter, the verification of employment and the letter from the employer, something just seemed a little bit off to our underwriter. And so they called the employer just to kind of verify what was on the letter and what showed on the verification of employment. And the employer goes, I didn't write that letter. Right. And obviously the underwriter, that's red flags.
Yeah.
Right. So underwriter calls me, we have to get legal involved because now it's, considered loan fraud and everything. And we ultimately ended up having to, we couldn't do the loan.
Yeah.
Because as soon as loan fraud is introduced into the loan file,
you're out.
Yeah, it's not good. And I mean, and you could have taken a step further and reported it. And I don't know what Momentum ended up doing on the back end, but that was a pretty crazy, scenario where we had a borrower literally try and, not forge documents, but they, recreated a letter from their employer to make it look a little bit better and qualify. So
what did they say when you brought this to their attention?
They admitted to doing that. Right. And then they just said, well, I didn't think it was that big of a deal. Yeah. I didn't state anything untrue, and that wasn't necessarily true. There was some statements to embellish and make, everything look a little bit better. And so it was them trying to justify it. And in some respects, I understand what, he's like, I was just trying to move it along quicker. And, and I get it, mortgages can be frustrating and, but, never forge documents, or that's never the way to get it done quicker. Ultimately, it ended the loan process. And so that was probably kind of the craziest one, where it was just blatant, I'm going to call it fraud. And
that's what
it made it really difficult. So,
well, thanks for sharing. We've got some more stuff we're going to talk about in a minute, but, everybody, whenever you engage with us on a property and you're going to use financing, you're probably going to be talking to JT. So I wanted to introduce you to him. You did good.
All right.
Appreciate it.
Yeah. Happy
okay.
to be here.
All right. Thank you very much for listening. We'll see you next time.